All right, everybody, what's going on? What's up? Just doing a sound check real quick, make sure everything is good to go. So we've had some, let me get the Discord connected here. All right. What's going on, everybody? Happy Friday, huh? Yay. TGIF. So we had a little bit of a push, and it looks like we might be able to close that gap today. Maybe. We're kind of stalling out. The ES is really representing where we're headed better than the SPX. And that's because the ES was open when we got the drop this morning, right? So there's a gap that needs closed, like a liquidity gap, not a price gap. 58.43 and a half. We got to get back up there, and it's, I don't have it to the tick perfect, but it's close enough. It's the start of that candle, right? When Trump said something about the EU and Apple, and then we had that move. So we got to get back there, and the ES is almost there. Now, if we can get there in the ES and we don't immediately sell off, then you want to swap over to the SPX and keep your eye on getting that gap closed to where we closed yesterday, right? So one is a liquidity gap, the other is a price gap. The effect is the same. Interesting enough, we were able to get back above 5,800 today. So it's a good thing, right? It's what we've been worried about. So there's been a lot of talk about bonds, right? We heard about bond vigilantes and how the bond market is upset with the House and the bill that they passed to send to the Senate, and they're letting their displeasure be known, blah, blah, blah. There was some shenanigans this week on the 20-year bond where they said there was a lack of participation and we dumped from that. So of course that got people asking, "Hey, are we ready to go long in the bonds?" And really, for a swing trade, right? Not just a short-term trade. If you're interested in running a long-term or a decent term swing trade on bonds, put it into the perspective of why would bonds come into play. It would be a trade on the interest rates, right? Just to keep it simple and sweet. Do you believe inflation is done and the interest rates are going to stay where they are or go lower as the Fed cuts? And if you believe that, then you probably want to go long in swing trades through the year so that, later in the year, the Fed cuts and rates go lower and bonds improve in their pricing and go up. But if you don't believe that, if you think inflation is not done, it's likely to come back as the tariffs hit our corporations in the next earnings cycle, and we're going to see inflation rise, and that maybe the Fed has to raise rates to deal with that rising inflation, you don't want to go long bonds. When we put it in that perspective, it really just clarifies what's going on, right? What we need. Now, sure, we can look at price action and say that's a double bottom breakdown where we hit, a 1, 2, 3, 6 or a 111, and we're popping back the other direction, and it's a TRB setup, and we could run back into the 80s, high 80s into the 90s. Sure, maybe price action is price action, but that would be a short-term trade based on trend, momentum, breakouts, price levels, all of that stuff. We don't need the macro if we're just going to trade price, trade what you see, look at the candles. But I've tried to marry the two over the years to where I have the backdrop, why I think bonds are going to go up or go down, or anything else, really, equities, indexes, whatever we're trading. We have the why should it move, and then we have the what's my trigger to take the trade. So there you go, right? We can always trade price. If it's a low risk entry and LRE and I can limit my risk, I am more than willing to trade anything. I don't care if it's baseball cards, if we're just trading rocks, I don't care. Whatever. If it's low enough in the risk, yeah, I'll try. Why not? So hopefully that shines a little light on the bond long question. And really, I mean, it's hard not to want to take bonds long, right? After this historic beatdown, and really just looking back at where we came from and how long it's been since we were at this level. This is the 2007 low, and we visited that in 2023. Sure seems like a fantastic time to go long on bonds off of a serious support level. And we talk all the time about how if you wait for confirmation, you got to pay for it because nothing's free. If you want a trade that is confirmed, you're going to have to pay up. Doesn't make it right or wrong, good or bad. It's just what's the outcome of the choice that I make. So if we get in early, we are not waiting for confirmation. And that means statistically, we're going to lose more often. And that scares new traders. They don't want to lose more often. They don't want to lose at all, right? Losing is a scary thing. So they just stop right there. But what if you are not scared of loss? So we're going to lose more often, but our losses will be smaller. If we wait for confirmation, I actually said that backwards. If we don't wait for confirmation and we get in, we will lose more often, but the losses will be smaller. If you wait for confirmation, you won't lose as often. That gets traders' attention. Not losing as much sounds great. And if we have confirmation, statistically, those trades work out better. But they still lose, right? Because everything loses at some point, no matter how good the trade. It can be perfect and still lose. So there will be losses. And unfortunately, if you waited for confirmation, you needed a bigger stop, a wider stop, your risk is larger. And when you lose, your loss will be bigger. So either you lose more frequently but take smaller losses, or you lose less frequently but your losses are bigger. So, is it a good time to go long bonds on this low? Absolutely. If we're just using price and that's the only thing we want to consider, then this is a really good time to go because we're on a real solid level and that's a good time to do it. But the macro backdrop says, we've still got a lot of scary stuff when it comes to rates and inflation and what the Fed might do and all these tariffs. And speaking of tariffs, there was a post earlier today, which you kind of need a little bit of backdrop. Um, The White House has said multiple times, and this includes the White House administration. So, Secretary of Treasury, all those guys collectively, they've said that uncertainty is a part of the current administration's tactic and strategy. They're deliberately causing uncertainty. They want uncertainty. They're using it like a weapon. And today we've seen a post after Trump attacked Apple and the EU and threatened tariffs again. We've seen a tiny little headline come through that said, um, tariffs keep uncertainty unabated. Now, they got to make it sound complicated. Tariffs keep the uncertainty going, right? It's still going. So when the uncertainty gauge gets too low, the administration or the president will tweet something, say something, cause drama, and get that uncertainty whirling again. So they're deliberately doing all of this. That really makes me not want to try to anticipate or hypothesize on where we think bonds and yields are going. I don't want to guess. The macro backdrop with that scenario kind of just breaks everything, right? They are deliberately causing chaos and messing with the market. Technical analysis is designed to look at what we've done in the past and evaluate what could repeat again in the future. It has no bearing or interest on somebody deliberately screwing with the market and messing with things. So we want to approach any trade with dollar yields, bonds, approach with caution. But if you can get it low enough in your risk, then why not, right? Why not? So that's my take on things at the moment. That it is a deliberate shenanigan that they are causing. If we just wanted to put money in some, secured interest account, we could just run bonds and right now can lock in 7.1%. I mean, you might as well just do that, right? If we're talking about trading, then, let's talk about trading. But if we're just going to run fixed income, then 7.1 sounds pretty good. I'm gonna post this in the chat. You'll get a I just posted it in chat, so let me bring it up for those who are gonna watch the replay later, since this can get buried. This is from my public account, right? So I brought up the app while you were talking, and I clicked the button that said new account on Bond, right? I've got capital in there, so it would just use my existing capital and say, give me a bond trade. And that's what it offered. I didn't even get any farther than that. I just stopped there and took the picture. That's what they're offering right now, 7.1%, locked in, even if the Fed cuts rates. You can receive monthly interest payments, woohoo, access a diversified bond portfolio, and you can get started with as little as $1,000. Cheers. There's your fixed income. You do. Yep, you do. But that's your fixed income, right? Which is what you're alluding to when you talk about, selling it weekly, monthly, whatever. And that's a 5 day. So you would sell it every 5 days. If you want fixed income, just do that because it beats your 6.1 with a 7.1, and it's guaranteed fixed rate. I don't have to worry about cash secured puts, or I don't have to worry about anything, right? Just done. You would finish going through the app process where it says, how much do you want to allocate? It's a process. Like, they handle all of it. All you got to do, public, 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 right? Public is a trading app that is like hands free. For the It's usually what I recommend to my family members, my sister-in-law, those kind of people who say, hey, I want to get started, but I'm not a trader and I don't want to learn how to trade. Here you go to Public, right? They do it all. You just make the decision about how you want to do it. You want to do fixed income, there you go. You want to do, a mag 7, sure, they'll offer that. They do a lot of thematics, which is really fun. You can build your own thematics. It's an awesome app. They do. I don't ever use it, but they do. Yes. Um, I know they do because I've gone to it, but I've never used it. So here's Public. It's always those two dots. It's their little icon that they use, and of course, I can just sign in. Let me get on the right screen here for a moment. No peeking, and I got to validate because, of course, they're going to ask, "Are you you?" Yes, I am me. Prove it. But a lot of options trades that I see discussed, not just here, but in general, it's like people are trying to mimic fixed income. And if you are trying to mimic fixed income, why don't you just go do fixed income? So here I am, I'm logged in. I have 26 cents of buying power because everything that I have in this account is used in this account. And then from here, I don't know, I've never used the web version, but it would be starting a new portfolio, say like with bonds, and we would go bond account right there, get started, 7.1% yield locked in. Same thing, right? I just took a picture of that basically on my cell phone, and I would hit the get started button right there. Of course, I don't have 1,000 available. I'd have to liquidate something that I'm already holding, but or bring more capital in, one or the other. Fund the account, get paid monthly, hold the bond investment. Done and done. It's likely, yeah, it is. And they do have their own little AI up here. I could click on it and ask it, how are they offering this yield? Blah, blah, blah. I was just thinking about that, baby. That and the eyeglasses. We didn't get the eyeglasses. Want to shop around this afternoon? See what you could find? I know, right? This is When people say, "What do you do all day if you're not trading?" I'm hunting, I'm learning new things, I'm finding new opportunities, and this fits in that category. The more I get into bonds, the more I realize this fixed income is what we've been doing with, credit spreads or attempting to do with credit spreads for a long time. Might as well just do the bond. 7% is not bad in a market backdrop that we're in right now, right? All the uncertainty, the shenanigans, deliberate obfuscation. I can't say that word very well. Why not go this route? Obviously, you can do better if you're finding high momentum trades, right? And a good solid trend with a good backdrop, but we're not in that environment. So, you know, go with something else. You could do it on your own. You don't need public to do it, right? But that would require that you know what spread that you're running, and it can get a little confusing. So I tend to just use the app. Hey, the app is also really cool because it'll check like Apple and Meta and Microsoft and look at their corporate bonds to see if they've got a really nice bond rating right now that they're offering, like a 2 year, 5 year, whatever. And that's nice because you don't have to search through a ton of stuff trying to find it on your own. It'll just find it for you, if there is anything worth finding. Most of us, when we think bonds, at least for me, when I think bonds, I always think of government treasury bonds. But in the last few years, as I've studied more 401ks and those, fixed income portfolios, it really got me focusing on corporate bonds like Meta, Apple, Microsoft, Amazon. Those hyperscalers have a lot of money for a reason. They tend to offer a pretty good bond. Oh yeah, absolutely. Schwab, Fidelity has bonds too. Absolutely. And that way, when you do go into options, you're not struggling to mess with a fixed income play. You're saving it for something special. Like I was hunting for the SPX today. I really wanted to take this short, this 58.40, 58.60 call credit spread. I wanted this if we made it to yesterday's close. I was going to put this on $9, maybe $9.50 in credit. But of course, we didn't get there, right? We stalled out before we did. That would have been a really nice trade to put on. The one I put in the chat yesterday worked out really good too. I rolled it already just to lock it in to make sure it couldn't lose anything. But I did that because I wasn't expecting this overnight drop. I was expecting a nice, slow, steady decline. And when we got that really sharp drop, it spiked the options prices really fast. And I knew it wouldn't stick. So I went ahead and rolled the 4,900 put up into 5,200. So that's now the current position. Just bring this over. I know it's small, it's probably hard to read. So I'll grab a picture of it. But the new position is now held in a credit. It is a long put vertical, so I bought this, but they're now paying me to hold it. I can't lose. The smallest amount of money this trade will make is $1.45, but it right now is offering me $1.45 and an additional $1.10. So it's up to 55. I made my 95 cents back, and everything else is profit. I could have closed it this morning. It was up $600, but the trade is worth thousands of dollars. I'd rather, get at least 1,000 out of it. And at this point, if I don't get anything, I'll get my $145. Why not, right? Take risk off, throw it in the corner, ignore it. I don't have to babysit it anymore. And it's a May 30th trade. So if it works and we continue to fall, I'll make more money. And if it doesn't and we rally back, then I'll just make my 145. And I might get bored along the way and add another vertical on the other side, turn this into, I don't know, like a skewed butterfly or something, maybe. See what we get, right? So I put that one in the chat yesterday, and when I filled instantly. The first one that I was working on, I had the wrong strike. I had 54.20, and that was the wrong one. I was supposed to be on 54.15, so it wasn't filling, and it wasn't filling. And then when I adjusted the strike, I didn't back the offer up a little bit, and it instantly filled at 95 cents. So when I put it in the chat, I warned people, hey, if you're going to take this trade with me, try to get it cheaper. I don't know if any of you did get it cheaper, but I felt bad. I think I could have got it for at least 85 cents, maybe 90 cents. Don't sound like much, but it's $5. I mean, that's commissions right there. But no dice. I almost put another one on just because of that, but I didn't. Oh, yeah. I mean, Triple B is not bad, all things considered. It's not junk. You know what I mean? So it's all right. Right. You're not stuck with it. Um, some of the criteria that I like to focus on is what's the maturity, right? How long am I gonna need to hang on to this, or at least what's the life of it? And uh, then I look at the rating, because if it's a 6 month trade and it's something in the C's or the D's, if I've got a nice price on it, I might do it anyways. But if it's something that's 20, 30 and it's a D, I no, I don't want it. So it's a little bit of a checklist. What's the maturity? Then what's the rating? What are they offering? It's a good place to get started. And doing it your way, you don't have to have a fixed amount, right? If I go back to public and I want to go ahead and start one of their positions, I need at least $1,000 to even put my foot in the door. Well, that's a bit prohibitive to other traders, especially if they're new to bonds and they don't want to mess around with fixed income of that size because they haven't done it before. They hear $1,000 and think, I don't want to do that. It can sound a bit scary. I should have made a video on that roll. It rolled instantly, by the way, so I was a little frustrated on that. Um, and in the roll too, I had some choices, right? Because I've got two strikes, the 52, 15, and then the 50 or 50. 254.15. So I was adjusting things. Some of it was offering $300 of credit, $200 credit. I went with 140 something to get me where I am now. And really, all I rolled was that back leg from 4,900 and I brought it up. If I had moved both legs, I could have gotten a lot closer to the money, but I would have had to have narrowed the spread significantly. And I just really didn't want to do that. So the trade has 7 days. Just keep in mind that there's a holiday coming, right? So we're not going to have um, as many days as we think. Some of this is going to get theta locked on us because we're gone Monday. And when I was shopping around for what strikes I was going to use yesterday, it was actually their trading activity that got my attention. There was thousands of contracts traded at 4,900. They didn't hold any of them, but that's what was coming in 4,900. I had pictures of it. I put it in the chat. Um, if they had held any, we would still see them today, but they didn't even hold them. And then the other one was 54.15. There was also a lot of trades, but again, nothing here, right? So those were done and dusted and closed already, which is a bit frustrating because how would we have known that, right? You just don't know what they're going to do when they're putting it on. Let's scroll back to yesterday, see if I can find these pictures where I had the volume. Maybe. Keep too much stuff. All right, here we go. Let's open this up, put it in the chat. That was the 4,900 strike, and this was the 54.15 strike. And then I spotted these being traded in the time and sales. And these. I'll bring these over so people can see it on the stream. All right, so 4,900, May 30, the volume 10,000 contracts came in when there was an open interest of 3,800. Now we look at this strike today, and the open interest is not 3,800. It's like 100 and something. So they opened all of those and then closed all of those, plus most of the ones that were already in there. but we didn't know that at the time. And then here's 5,400. There was 2,800 opened, but all of those are gone too. At least maybe half of those are gone. If we look at what's traded today, well, look at the price. They were paying 92.30 when these had a price of $87. So they paid up quite a bit, but it was a part of a spread. And that's, just SPS SPX shenanigans, which is what we always warn people when you're trading the SPX, the bid ask is really wide when you start going farther out in time, and the spreads can really whack you hard. And that's such a great example there. 92.30 when the high end of this was 87 on the bid ask spread. And then same thing here. And it wasn't like a one off, they were doing it again and again and again and again. 1770, they paid 1870. That's a dollar difference higher that they paid up yesterday. It's crazy, right? I thought it was crazy. Would you willingly pay an extra $100 for a spread just to get filled because you want it that badly? I know, right? Like, how bad do you really want it? And then they closed it because those are gone. They were out of them by the end of the day yesterday. Yeah, but we can't use today's, right? Because they closed them yesterday. Because if they'd have held them, it would have shown up in the open interest this morning. That's true. I did like that comment about, they're continuing to elevate the uncertainty. That's their goal. Like, well, that tells us quite a bit. Hmm. So, anyways, we've covered the bonds. We covered the SPX trade. Um, I did have something. If you guys want to talk a little bit of 0 day talk when it comes to options trades, I don't know if anybody's really into 0 day options trading, but strike selection is kind of a really big deal, right? And when I can, I try to find ways to explain the choice scenario. It's not about telling you which one you should or shouldn't trade because that's not my goal and it's not my purpose. We all make a choice about what strike we use based on how much stomach we have for risk, how much we're willing to risk, blah blah blah, right? So I'm not trying to tell you what strike, but to demonstrate to you the impact of our choices, yesterday offers us a really good example. At 3:30 yesterday, we started to fall, and we fell over 40 points in 30 minutes. So that offers us a really great example of what options strike to trade yesterday. And if you guys are interested in it, we can walk through a scenario of what would have been a good options choice here and why. Because in the future, if you want to try to take this trade, you're going to want to answer that question. What strike should you choose? It's 0 day, so we already have the date chosen, right? That's not going to be the issue. It's just what strike. Do you want one that's really far out of the money? What they tell us in the options books is that it is acceptable to pick your strike based on where you think price is going. Well, let's just suppose we had a crystal ball and we thought it would go to 58.40. We have reasons to think that it was the open on the day. And a lot of times we just go back to the open. We could have said that because it was really close to the previous day's close. So we were just, going back down to the pivot point. And either one of those are reasonably decent answers. So what if we bought an out of the money 58.40 put? How much you think that made in the fall? I mean, that's a hell of a fall, right? 40 points. You think it made any money? And would it be worth the risk? Yes, sir. On a 0 day. Maybe. It made a little bit more than that, but not much, right? You're on point. You're hitting the ballpark, right? That's the takeaway. If you use an option like that is out of the money, even if we fall 40 points, you're not going to make jack, right? Like you're not getting much of nothing. It won't let me look at yesterday's because it's already gone. But I got some of it on video because I was making a recording, so I can bring up the screenshot later if we really want to nerd out on it. But the takeaway was that put that was out of the money, since it closed out of the money, it didn't make any money in the fall until the very last 10 minutes, right? And then it really made money in the last 5 minutes. And so if you held it into 350 and 355, that put actually made like $3 and it was bought for 15 cents. So I mean that sounds awesome, right? But if you held it from 330 to 345, 347, it never made it more than 50 cents, which still sounds good. I paid 15 cents for it and I sold it for 50 cents. Yay, I made some money, right? But it moved 40 points. Wouldn't you want to make some serious money in a 40-point move? Because you were right. You thought it was going to go down, it went down. Where's your profit? If you had bought the option that was at the money or in the money, this trade made a lot of money. That was the takeaway. And I do have the video, but it's not finished. So, I mean, I can always just share what I did record and you guys can check it out. But it's one of those open ended ones where I didn't get to finish it. But it really highlights if you're going to trade 0 day, especially if you're on the last half of the day, instead of, like in the morning, we got more choices. If you're in the last half of the day and you think we're going to get one of those wild moves, maybe consider choosing one that's at the money or maybe just slightly out of the money. Don't choose one that's really far away because it's most time's not going to pay you what you're risking. And you'll say, well, yeah, but I only risked 15 cents, right? Okay. Risk 15 cents, maybe you make 30 or 45 cents off of it. It's 150, 200% profit. Yay. But, if you want to make a couple grand, get something at the money or in the money. That's the takeaway. So I do have the video if anybody's interested in it. I thought it would have been a really good learning point, especially because we all kind of struggle with what happens if I choose this strike? What happens if I choose that one? And in a 40-point drop, I mean, come on. You know how frustrating that is? I just put that video in the chat if anybody is interested in it. Help yourself. It's not a very long video because, like I said, I didn't finish it. But there are some really good 0-day strategies that I like to play. And over the years, Jeremy turned me on to one that I never would have thought to do on my own, which is to use XSP or SPX, something that doesn't have stock that you can't be assigned, and actually go in the money on the credit side. When he first said that, I said, what fool in their right mind would put on this trade? Right. And he was like, me, it's my trade. Like, what are you, an idiot? He's like, just hear me out. Think about what the real risk is here. And he was right. Without shares, what is the real risk? Cash assigned? Fine. If it has some kind of credit, great. And if you lose all of it, you're down 8 pennies, 5 pennies. That's $5. Yeah, that's what I was trying to work on yesterday. Of course, I got interrupted and I ended up pausing the live stream that I was doing, and then I never got back to it. But there is a lot of opportunities to 0-day trade. So many tactics and techniques that go into it and approaches. I like to split the day up into two parts, the morning session and then the afternoon session. There's times where I want to do like a skewed butterfly or a broken wing fly, or like today I was stalking the market to put on a short vertical, but we never got to my entry target. I like those days where we really move in the pre-market and we open really low like we did on Monday. If the ES, has a wild overnight and we open way low, that's one of the few morning verticals that I like to put on. And I try to do it at the money or near the money, but I know a few traders who will go from there another 1% lower. Right? If you think about it, it's already down, say, 1% on the gap. And then if you open a trade where you went another 1% out and then you sold a spread, your chances of losing that are very, very low because you're now saying you think the S&P is going to make a 2% move on the day. And yes, it can do that, but it's a very rare thing. I don't like that trade, but a lot of people do. I like to take it near the money or at the money. if I do that one. That way I'm risking, say it's $5 wide, and you can fill in the SPX for like $1.75, maybe $2, because it's the SPX. You won't get a fair price. You just have to resign yourself to that. It'll never be a fair price. But you can get something like $1.80, $2 for a $5 spread, and then run it, right? Or make it wider if you're more confident. I've done 100 points wide. I've done 50 points wide. Most of the time, I do 5 or 10 points wide and just add contracts. That's more comfortable on the stomach, right? Plus, you can fade out of it, feather the exit. But 100 points is fun. If you have never done it, you should try it one day. Even just do it on paper. See what it feels like. It's a little wild. Don't knock it till you try it, right? So an extreme move to one side is a good time to do a 0 day spread for me. Usually, when I talk to people about 0 days, they want to do them every single day. And I'm not a big fan of that. Generally, it's because of the expectation of price. Some days we're trending and rocking and rolling and making moves all day long. Some days we do a half back reversal and go back the other direction. So I don't think that every day for me is a 0 day play. That's kind of where where I detour from the group. So if you're going to do 0 days, my approach would be recommending identify the kind of days you want to do them on, and then what kind of 0 day do you want? The buy side, where you're buying cheap lottos, the sell side, where you're targeting far out of the money, which is the common approach, or near the money, which is my approach, legging in additional contracts so that you can put on like a risk-free iron condor. So many tactics. What's cool is a lot of times we know if it's going to be a sideways day before the bell even rings. And that's not perfect. We get it wrong. But if you watch my morning briefings, a lot of times I'll tell you in the briefing, I don't think we're going to go anywhere, or I think we're going to break out. And I'll lay out my argument for why I think we're not going to go anywhere. Usually it's something simple like tomorrow's FOMC and nobody wants to trade and volume's really light, and you know what I mean? Like it's pretty obvious. And then other times it's a little more complicated, or it may be in earnings or something, like something really big. Nvidia has held us back before. So we can spot the lack of flow, lack of liquidity, lack of movement in the pre-market, and it kind of gives us an idea that we very likely aren't going to do anything. And a lot of times on Friday, we get a hint for what next week has to offer, and that gives us an idea of what Monday and Tuesday can be, so that we can anticipate sideways days, Monday and Tuesday. And of course, you could put them on today and get more theta, so that when you put the trade on, 2 days in advance, you get more money on the sell. But it's not a good strategy for me if it's a short week, right? Because this box doesn't function correctly on a short week. It looks the same, but it's wrong. It's broken. It's not real. You want to draw them by hand on a short week, so you'd have to wait for the market to close and then get the expected move levels, get the calculator, do all the math, and then set it into place. And we don't have any hints at this point what next week has to offer, so can't play that. But when it's there, it's a good play. That's kind of the takeaway on it, and that's why I don't think that every day is a 0 day strategy. If you do run it that way, what I have found is most people trade it pretty small, right? Trade small, trade often, the whole tasty trade theme. And then it becomes to where your P&L looks a lot like my chart. A lot of waves where you're just kind of moving around but not really getting anywhere. And then you finally get somewhere and you start giving it back again. That's what I have found. If I try to run it every single day, that's about the outcome rather than picking the opportunity to trade it. Mm. I have argued that myself. They have a credit spread like checklist, the qualifications that they need to put on a credit spread, and it seems impossible to hit the qualifications that they deem necessary. And I have finally adjusted it and made my own checklist because theirs was impossible. I could not hit all the things to have that kind of delta for that kind of credit that far out in time was just impossible. And they had examples of it that they did in back tests that said that that was the best possible credit spread criteria that you could use. And I thought, how did you even find one example of this, let alone enough examples to do back testing and show that it's the optimal amount? I couldn't find one ever. I still haven't found one. So I finally gave up and started using my own. Seen a gap fill picture posted in the chat, so I brought it up. Thought I'd take a look at it. Looks like a 30-minute chart, right? So I was looking at the ES because when the president announcement came in, we had that really big drop. It was easy to see. When I come over to the Nasdaq, whoa, Thinkorswim, what are you doing? It's acting all kinds of crazy. There's the big drop. Okay. Yep, that's the one. So a liquidity gap that I was marking on the ES, we can mark here on the Nasdaq. It would be the open of that red candle right there. And that is the liquidity gap, which is different than the price gap, right? It's just two different things. If we're doing the price gap, we would focus on where did we close yesterday and then where did we open at 9:30 today. And for that, depending on the broker you use, I have found it easier just to go out to the daily because some brokers will mark the 4 o'clock close, some will mark the 4:15 close, some will mark the 5 o'clock close. So if you just go out to the daily, then you can mark whatever their daily close was. And if we do that, it's all the way up here. So we just go back into the intraday, and now we have both of those. There's yesterday's close, way up at 21,215. And there's the liquidity gap close. Technically, there was two, right? There was Apple first and then EU second, kind of back to back, but one gap at a time. Get to the first one and then get to the second one. Yeah, price is also telling us it's going to be a stall area, right? We're coming into 3 o'clock, so power hour is about to begin. And we've got this nice little packaged range, like a raid draw scenario. So we're in the draw right now. We would watch for a raid and then the move. If we look at this and we try to consider where the liquidity would be for them to rate it, I would think it's at that 21-1. It's the gap close and it's where they could find a lot of liquidity. So they would raid that and then drop the other direction with their loot. We do have a trend line breakover forming. Um, you know, the line doesn't really matter. It's more of the idea that we've quit making those higher highs in a systematic fashion and we're building a base or top. So we're getting into a trend line breakover. We just haven't broke over yet. You can see various examples of that in the past. Don't stress on the trend line. It's usually what I get asked. Do you use the wick? Do you not use the wick? Do you use the body? Don't. It's just a visual representation to help you out, to help you see the breakover. You could use moving averages. Um, you use a crayon. It really doesn't matter. One thing that I like to do if you're struggling with these is use the Linreg. So usually you'll find like this R line. Use that and then just snap it up. And you're basically looking for when we start getting the base, the top, and then we start looking for those lower lows to form. So it's not a perfect science. It's interesting too that if you're looking to do work on this sort of stuff, turn on the point of control for each individual candle and look at how those close. TradingView's got a really nice system where it'll do the footprint charts with the point of control on the footprint, but you can also just get a more generic volume profile per candle. And then you draw your trend line like we were just looking at, and you look at where was the most amount of volume on that candle as that trend line was getting hit. And it's interesting to see where the greatest amount of volume was, just like you're talking about. If you were watching the tape, you'd see it come in. But what if we weren't watching the tape and we want to look back in the past? Then we could use something like volume point of control. Um, look for PVP on TradingView, and I just turned it on, and now you can see that little white line. And that little white line is representing where the greatest amount of volume took place for each candle. I'll turn the other one off because it's kind of distracting. When I'm doing really short term trading, I like to have that on so that it helps me understand where um, the greatest amount of trading took place in the previous bar. So that when I look left, I can try to see if there's anything that stands out. It can be kind of noisy, as you notice when I zoom in, it's getting louder and louder, and now it's crazy. So you can go in and adjust the settings so you don't have all the other stuff. But if you stay zoomed out, it's not bad. Tradeovate itself also has this, by the way, but it's not a single line. It draws it in like a little box. It's really frustrating because it's ugly on the chart, really distracting. But Tradeovate does have it on their platform. Nice. That's a good tip. Trendline breakover is one of my go-to trades because we can see it coming from a long ways off. It doesn't sneak up on us. And I like to have trades that I can see coming. Yesterday's high, yesterday's low, breaking out of the Globex. We can see those from a mile away. They never sneak up on us. Same thing with these trendline breakovers. Because what I don't want is to suddenly be there and like, oh gosh, hey, there's my trade. No, 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 no. I don't want that ever. I trade it, unfortunately. I'm as human as anybody else, if FOMO, excitement, shock and awe. Maybe I just see something and I trade it, but I don't like those. I'd rather trade the ones that I see coming. Gives me time to evaluate, go look around at the other markets, dollar, bond, yield, news, maybe go get a drink of water, step outside, stretch my legs, come back, and still have time to take the trade. No rush, no worries. Don't always get that, but that's what I'd like. So, really, with the headlines this morning, um, they were a deliberate attempt to disrupt the market, not to get us to crash and burn, just stall us out, stop us from going higher. And if you look at the dollar and yields, the dollar is now back down to 99. That drop really continued nicely. ES rolled over, the 10 years come back in again. And so this was this was their plan today. It's why they did it. Now, are they going to stick with this Apple threat? Who knows, right? Maybe they'll take some capitulation from Apple. Maybe. Um, does anybody really think they're going to put higher tariffs on the EU than they have on China? I mean, come on. Does that even make sense? No. So they got what they accomplished, what they were trying to accomplish: disrupt the market, stall us out in front of the weekend, and then we'll come in next week and we'll have something else on the table to deal with. But we really don't have anything for next week, at least not yet, right? I'm looking ahead and I don't, it's too soon to be anything else, right? When non-farm payrolls and all that. We're near the end of the month and it's a holiday week. Not really expecting a much. Yeah, I covered a little bit of that. Yeah, and the 10-year yesterday, the 20-year on Wednesday, we had some behavior like that. And so today I was asking, what do we really have on the table for today? Nothing really, right? And when you look out into next week and you ask, well, I mean, what do we really have for next week? Not a lot. So the minutes might be next week, but I don't think we have an FOMC meeting next week. Um, Pal's supposed to talk. Pal's supposed to have some kind of ceremony. Pal's supposed to have a ceremony Sunday night. But as for like an FOMC event, minutes would be the only thing that I would expect, not actually an FOMC meeting. So the minutes can provide some insight. Usually no, though, right? Because they try to telegraph in advance so they don't shock anybody of anything that might be in the minutes. So we're very likely going to see um, a reiteration of what he already said, and then no forward guidance because they've been very careful about not setting any targets or goals. Just we're in a wait and see mode, and we're monitoring the data, is what they keep saying. But when we look at the minutes and we look back historically, there have been times where the Fed has said, "Hey, we're watching this, and if you know, I don't know, well, let's say jobs. If the jobs numbers gets above this level, we're going to have to react." Or they would say, "We're going to cut 25% over the next 3, 4, 5 meetings." And so we know in advance what they're going to do. That's lining us up. Sometimes they line us up, sometimes they do not. And right now we're in the hurry up and wait mode with no lineup. So we have no idea what qualifications they're finally going to use to cut. And no, there's no cut coming anytime soon, right? That's not even a possibility. There is a great website. Exactly. Yeah. Here's the website that I use. There's more than this one. Somebody asked me the other day, if there's somewhere else to go because they saw a graph that looked completely different than this. There is. I don't know. I'm sure there's a ton of them. This is just the one that I like to go to. And if you look on the left side, you can change how it looks. But I like the way that this looks, so I don't ever change it. But you have choices. So across the top is your FOMC dates. Next year's are grayed out, and be aware that those dates can be changed. They're not set in stone, but that's the projected dates at this point. So they are grayed out, and then you have this year's. And down at the bottom, it's 24 hours. So this thing isn't, like running to the minute. I think it's 15 minutes delayed, and it updates every 15 minutes, something like that. We can see 2 o'clock was the last update. So maybe at 2:15 it'll update again. And yeah, I don't know. I like this one. I think it does reasonably well. And you can poke ahead and see, what are they pricing in or what are they unwinding out of the market? What is it? Bar chart, I think, has a version of this that may be a little prettier. Just put lipstick on a pig. Kermit and Miss Piggy. Absolutely. Saturday, Sunday, absolutely. Yes. You looking for a 0-day play? A good way to approach these theta plays is to treat it like a box. Kind of evaluate from a chart standpoint how likely it is that we're going to stay within a particular range or not. And then from that, how much money can we get out of it? The closer we can get to price, the more money we can get, but the more risk we have to take, like risky behavior kind of risk, not how many dollars at risk, right? Two kinds of risk. So it is riskier to get close to price, but it is less money at risk when we get close to price. So it kind of goes back to the earlier argument of you may lose more often, but your losses will be smaller versus you may not lose as often, but your losses will be bigger. So if we go out to the daily chart, kind of take a look, the standalone would be highs, right? So 597 and a half, whatever that high is up there, 597. Let's put price on it so we can see it. Round up 597. Okay. So that's a standalone. We could sell calls around 600. And we could do that today. We wouldn't get any money, but we could do it. We could do it for Monday, right? And the farther out in time we go, the more money we'll get. But the farther out in time we go, the more likely it is that we can get hit. How likely is it that we're going to hit 600 by the end of the day? Really unlikely, right? Really unlikely that we're going to go to 600 today. How about by the close of Monday? You really think we're going to get to 600 by Monday's close? I don't, or Tuesday's close, excuse me, because Monday we're not open. I don't think we're going to get there by Tuesday's close. Wednesday? Next Friday? So that's kind of how I approach where I'm trying to define a credit spread. Can I get closer than 600? Because maybe we go price these and we don't like any of the prices. So one thing, yep. For those of us who are not good with math, because that's one thing I hear from people all the time, let's define the edge and let the computer do the work, right? Let the broker do the work. Think or swim. I'm on the risk profile, got the gray area and the darker area. We have the calendar up at the top. Set that for Tuesday. So that would be the 27th. Yeah. Now we'll zoom out. This is the range for the XSP into Tuesday's close. Let's put those lines on the chart. We don't need the at price, so we'll get rid of that. Now we have those two lines. We'll set them on the chart. So click here, set slices to the chart, and boom. All right, there we go. So those are the two lines that it just gave us, and that's how far the market could move between now and Tuesday's close. Let's get rid of the one that I had, and it'll be those two. Now, if I want to keep them, all I have to do is change their name, and it won't move them. So Tuesday close, show name on the left, and this one, Tuesday's close, show name on the left. Now, if I give it any more commands, it won't delete those lines. If we didn't change the name and we give it new commands, it will remove those. So, you gotta own them. So now what, right? What else can we do? Right. And that's what I was saying. Now, what else could we do? We could add the market maker move to that distance, right? Because what I just marked is one standard deviation for Tuesday's expiration. And we can, adjust that as we wish, but that's what I marked so far. So we can bring in the market maker move now on top of that, which is another $1.46. I like to just round that up to $1.50, right? So we take whatever we got here and we add $1.50 to it. So the lines that you get will come from how many slices you have showing down below. So one of the things that I like to do first is I tell it how many lines I want, set slices to base 1. This is what I like to choose right there. And that'll put you on the edges of the gray area. And then you can just delete base, right? Because base is current price. So then you just right click, delete the base, and now you have your edges. And then from there, once we duplicate the line, if you click on a line and hit spacebar, you'll duplicate the drawing, whatever the drawing is, a box, a Fibonacci, whatever. Click on the drawing and hit your spacebar and you duplicate it. Double click on what you duplicated, we'll add $1. That would be 56 and then 50 cents. So 596.76. That is the market maker move added to the level. And I actually duplicated that too many times, so we'll delete one. Come down below, do the same thing here. Remove $1, so 8 goes to 7, and remove 50 cents, and that just goes to 0. So there's the market maker move added to everything. This says that we could sell options outside of 595. It's not a surprise. We were already looking there, the 600 level, and outside of 567 and a half. So we could use 565 and 560. Not bad. Yeah. I like the iron. I just don't think there'll be any money in it. And we'd probably have to do like a double diagonal instead. I think if you want the width and the credit, you need the double diagonal. The iron is nice, but probably won't have the credit we're looking for. Shoot. So we said 65, 60. I'm going 5 wide, but you guys don't have to. And then the other side would be 600 to 605. We can adjust it and get tighter, but that's kind of the starting point. I don't have enough strikes showing, so I'm just going to choose the wrong strike and then fix it. 603 goes to 605 right there. All right, so there's 11 cents. There's the reason why I said the double diagonal would probably be better. You can get even wider away from price if you want to. and you can get the credit you want. Now we can tighten this up, right? Because we were actually showing halves. So 567 and a half, we could sell something like a 570, 565, and that would put our break even on 567 and a half. So let's tighten that up. It'd be 560. Oops, I'm going way too big. 567. Oh, we don't have 567 and a half. It's okay. We can do 570, 565. It'll be close enough. And then on the other side, we actually had 597 and a half. So we could use 95 and 600. This gets us $5 closer and 33 cents in a $5 wide spread. Still not very much money, but we'll throw it in the analyzer. It's over there. Okay, so that's the iron condor. Double diagonal, on the other hand, and there's a few ways to do this, but we want the short one on Tuesday. That's a given. That's where we want to start. I would say longer, yeah. But in this scenario, let's talk about that real quick so that people can keep up with what we're up to here. Double diagonal, we need two dates in time. Okay. The one in the close end, closest to expiration, is the one we're going to sell. And the one farther out in time is the one we want to buy. It's a calendar if the strikes match. It's a diagonal if the strikes don't match. So the width of the distance between these two in time is where we're going to play volatility. The idea being that we want to buy low, sell high. So when we're looking at the volatility on the side here, we want to look at what we could sell that's high and what we could buy that's low. But that's tricky because the farther out in time you go, the higher the volatility gets, right? That's why it doesn't really work that well on a normal basis, and it's why calendars and diagonals are not like a go-to on a day-to-day basis. When you find that you look out on the options chain and the volatility gets smaller as you look out, that tells you you're in a really good environment for diagonals and calendars because then you can buy low, sell high. In the current market, when we're looking at these, we're not really finding that too much, right? But let's just work with what we have. So here's Tuesday, and we're going to tighten that up so we can see the strikes more. Tuesday has a 13% vol. And if we look farther away, nothing is lower than that. So we can't really play volatility. But we also have other things to play. The different buy. It's the same trade, just for different reasons. So kind of like when we do a credit spread, sometimes we just do a credit spread because it has a lot of juice and it doesn't really have a reason for us to go long or go short. We just look at it and say, I'm going to sell that credit spread because it's so juicy. But what if we want a credit spread and it's not juicy? Well, now we're going to have to use something else like price. So in a diagonal or a calendar, we would prefer to use a difference in volatility. That'd be the ideal scenario. If we don't have that, then we can just use the price of what we trade. So the downside was 65 and a half. No, 67 and a half. So we could use 65. I think that'd be a good place. I don't have 65 showing, so I'm just going to choose a 71 and then scroll back 65. So we get a 65 short put right there. Now we want to add a long put. Well, where at? We can do 1 day just to see what it would offer us. If we sell this for 16, I'm going to need more strikes. That's just the end of it. If we sell that one for 16 and we buy one for 53, then we're not going to like the outcome here. That's not very much, right? We need to do something a little bit better. And we're really getting hung up because it's that 565. That's really what's trapping us here. But because it's only 15 cents, right? There's not a lot of money there. But let's do it. Let's do a 60. We'll buy a 60, sell a 65, and that's a 7 debit. We'll put that into the analyze tab. That's the first half. Now we need the call side, which was, what did we say, 600 or 595? 600. We'll use 600. If we have to tighten it up, we can tighten it up. So wow, maybe we have to rethink that. It's a penny. 595. We'll sell that. And then we go out to, say, 600 and we buy that. And there's the other half of our double diagonal. Now, as you can see, the width is really wide. Yay, great. But there's not a lot of profit here. And it sags in the middle so bad that if price doesn't move, we're not going to get anything. We need this valley here in the middle to be above zero. So we need more money here. We got to get that by changing our strikes around, changing our date. We got to change something. What's very likely hurting us at this point is the Tuesday options are, one, really far away, and two, have no money in them. So we got to get them closer to the money, or we got to go farther out in time. We did the puts first, and we have a 60. So let's bring that up to 65. And then on the one that we, shoot, I did the wrong one. Let's bring the 65 up to 70. And the one that we bought up to 65. So that's one adjustment. It brings us inside the line a little. And then there's the other side. The one that we bought. Let's start with the one we sell. Make that 90. And we make that one 95. So we got closer and closer. Still above zero, but the number here on the bottom left is smaller. We're almost to zero. We want that positive. We're going to have to get out of Tuesday and use something else. If we used next Friday and then the following Monday after that, we'd have more credit and more debit in here. I did a video that's on the Bullish Bears website called the Marcus Trade. I named it after my my dog, Mr. Marcus. And it's a double diagonal built for S&P, so SPX, SPY, XSP, and it's using the weekly expiration levels. And I designed it because the weekly iron condor is broke. We just can't use it anymore. And I wanted to replace it with something that we could use on a weekly basis. And it would cover the width of the spread of the week's range and have enough money in there to make it worth our while. So that's a really good video to watch. And you can put that trade on every single week, by the way. The reason we wouldn't want to do it every week would be, say, a holiday week like this week, where we say, no, next week's a short week, don't do it. Or if there's a big event next week, like if next week was FOMC, CPI, PPI, non-farm payrolls, we might say, no, don't do it next week because we got these big, crazy risks. Right. So because this one is so close to expiration, it's all scattered. It's really nasty. This is a horrible one, and I'll show you guys why. The risk is $500 because these are $5 wide trades, right? That's why it comes all the way down to a -5 way down here. This is a really bad trade. But there's two parts to the trade. Well, there's way more than two parts, but let's start with just puts. The puts have a short put and a long put. That short put on its own, I can close that and keep the long put, or I can close both of the trades at once. So if we turn the calls off and we just look at the puts for a moment, here's the put trade. And we're going to zoom into a little bit so we can see this tent better. The put trade all by itself collectively is fine until we drop below 569 and a half. Now, the S&P currently is 581. So as long as we are not below that 569 and we're at 581, then this trade can be closed for a profit, preferably if we fall. Now, if we start getting over to where price is right now, we can see we're negative. And if I zoom way over here, now the loss is that $3 debit. So if SPY doesn't fall at all and it doesn't move towards our tent, then our risk is the $3 that we spent, or $4 now. So we have that risk, then we have the tent in profit, and then it gets really nasty below that, down to $500. Not a good trade, right? We would not want this one. How do we fix it? Well, we can get farther out in time, use Friday's expiration. Or two, we can make it a smaller trade because this is $5 wide. We could use 556 and 567, or just both of them 565. Make it a calendar, and then you get a shape that looks more like a butterfly. And again, this is just the put side, so we can do the same thing with the call side. But now that we made it the shape of a butterfly, if we don't get the fall, we will lose. The best double diagonal that you can make is one that has the loop up and then like this and back down, to where no matter what, you stay above zero until you breach the edges. But to do that, you got to have some time in the trade. And we're 1 day out. And that's why there's just no time there. And the trade looks so bad. So let's fix it. Let's put some time in it. Use next Friday's options. Well, if you think about the calendar, for people that want to do it daily, think about how you would do this. If we start today and we build one for the 30th, and then on Tuesday we come in and we build one a week out. So that would be July 1, right? Or July 30th. And then next week on Wednesday, you would put one on for the next day, right? By the time you get caught up, you now have a calendar for every single day of the week. There was just a lag of the first week to get it started. Once you've got it going, you have one expiring every single day, which is awesome. You just have to start with that first week of lag. You follow what I'm saying? When we adjust things a little bit, um, I moved it out to Friday and then the Monday after that. And I'm trying to put the shape back together where it's supposed to be. You'll see that the risk really isn't as horrible as it sounds or it seems once we put all the pieces in and we've got some time to it. This is still, something's wrong here somewhere, because we've got a credit on one but a debit on the other. It's very likely those puts. 570, 565. Somebody's asking about news, so timeout just a second. NUE, Newmont, Nucor. Oh, Nucor. Yeah. So $100, it really needs to keep that or else. Now let's zoom in a little closer. $100. Big gap down today. He said last few minutes. So yeah, shenanigans, huh? Look at that. Kramer talked poo on it, but that was at 8:30 this morning. Not seeing any other news necessarily on that, but did the rest of the market get hit? Nope. What is new? What is the what is this? Metals and mining, steel. Okay. I thought it was familiar. X steel also dropped for just a second and then exploded to the upside. It is steel news, whatever it is. What's another steel company? STX? S no. I've got a watch list. I didn't want to have to dig it out though. But you can see it's steel is getting hit. Metals and mining, materials, steel. And it's not just Newmont, it's also X steel. I would bet that there's some headline. There it is. Trump talking about still tariffs or still the sell of the X. That's what it was. Nippon Steel is in the final stage of discussions with the United States government. And then Trump came out and said U.S. Steel will remain in America. It'll be a planned partnership. And I guess that whacks Nucor because they were lined up to be a part of the trade, right? If the Nippon failed, then Nucor was the backup. Is that right? Yeah, I mean, it probably wouldn't hurt. I feel bad for those quantitative algo firms that are trying to develop a quant algo that will trade based on those tweets. How do you even set something like that up? I mean, it hurts my head to even try to work around it. But at least now you know what happened, right? Like it was, it's not like an airplane fell out of the sky or something, you know? Yeah, absolutely. So let's get out of the XPS thing for a moment and talk about a regular calendar, what it looks like, and then price one and kind of walk through it a little bit. We can buy July 18 and sell, like June 13. The problem is I know that July 18 has no liquidity, but you can see how that's a 70. Actually, we can use July 3. That's a 73. Nope, we need it lower, not higher. Yeah. The idea would be to buy the low one, right, when we can, and then sell the high one. And that makes a really great example to work with. So July 18 is 70 and July 3 is 72. So buy low, sell high. If we do this and just set something like a 310 and a 315 Got two trades in there. There's the diagonal. Okay, and that would be one piece of the trade, right? Just one side. Then we want to bring in the other side, so we end up with this like dog ears or bat from Tasty Trades. He always said they were bat ears, but this would be the low side. We got to get rid of the valley in the middle and put on a call side to where that middle area stays above zero from peak to peak. And the trade can only lose if we go outside of the peak on the far end, which is possible, but it's almost like swan event, right? It would have to be something crazy extreme. And then look at the loss down there. It's really small. It's the $90 that we see. We'll take that, right? So let's clean that up a little bit. There we go. So that's one side. And then we can look at the calls. All right, that 370's got more volume, not a lot more, but we'll use that. I should have went a little bit smaller, 375, so that they'll match. $5 wide on each side. There we go. So when you have a little bit of time in it, and when you can buy low, sell high, this is a really great demonstration of why I like a double diagonal or a double calendar. You can see that the middle never goes below that zero line, and that this trade would only lose if we break the outside, which is a long ways off. Now, how far away is it? If we look at the expiration, it's July 3rd and July 18th. So we can move the calendar to July 18 and see the gray area. It is. Nope. The call is costing you more money than the put, or the, excuse me, the one that you bought, whether it's call or put, the one that you bought is costing you more money than the one that you sold. So you will open this for a debit. You will, right? Because think about it. If the that's so when it comes to a diagonal, first let's talk about one before we talk about both. The reason that institutions don't like these is because unlike a vertical, we know exactly what our max loss is and what our max profit is. Diagonals do not have that. And in fact, it can shrink or it can expand based on volatility. So let's demonstrate that visually. Keep your eye on the yellow line, which is our perceived profit and loss. And I'm going to make the other line more visible too. And then keep your eye on that cyan line. Right now, the break even is these two vertical lines. That's our break even. And I'm going to leave those up there. And now I'm going to expand volatility a little bit. And what we're going to see when I expand this is that the break evens go farther away, which makes our trade more protected for us because it gives us more range in the move. And if you notice, the amount of profit is increasing as well. If you look at the top of the pyramid, it's rising up. It's getting closer to 1500. So as more and more volatility comes into this trade, the max profit increases, the max loss increases, the break evens get wider, all based on volatility. And it really helps our trade So if volatility spikes, our chances of losing go down. So it's very awesome. Unfortunately, though, the opposite is also true. If they crush volatility, the trade shrinks. So if we start going the other way and we start losing volatility, this trade is going to get smaller and smaller and smaller. Our max profit shrinks, our max loss shrinks too, but also the entire width of the trade shrinks and our tent gets smaller. And so when it comes to these trades, if we manage the trade and never break it apart, we leave it as one unit. It has to be closed by the early expiration, which is July 3rd, and we end up closing both at once. What it would be worth at that point would be how much money did we get from the put that we sold and from the call that we sold versus how much did we make in the one that we bought, or how much did we not lose in the one that we bought, right? Because we're hoping that that one doesn't decay too much, or it actually increased in profit. At the same time, we're hoping that the one that we sold lost money from theta. All things being equal, if price really doesn't move, the calls will slowly fade, losing theta at a lower rate than the options that we sold. So the ones we bought farther out in time, they'll lose theta less quickly. That's the play, right? But we all understand price isn't going to just sit still, it's going to move. And so when that happens, we have to determine, okay, the ones in the front that we sold are closer to expiration, they're going to lose theta faster, but the ones that we bought are also going to lose theta and price is going to move. Our calls and our puts, one side's going to make money, the other side's going to lose money. We don't know which side, right? But we have long puts and we have long calls. If price goes up, our calls make money, our puts lose money. And if we go down, the puts make money and the calls lose money. So you can break the trade up and trade the short ones all by themselves and then trade the long ones all by themselves individually. In your mind, you can just continue to focus on the front ones, the ones that you sold. Whatever way you have to do it to visualize it as the play so that you can understand where your risk is. Look at the July 18 theta, and we can see it's around 30 cents. And if we go to the July 2nd or July 3rd, the theta is in the 20s. So that's a little weird. It's supposed to be the other way around. It does, but it's weird, right? It's the theta. No, that's right. The theta increases as you get closer to expiration. Those ones that we sold are going to lose theta faster than the ones that we bought. So that it's not very much though, right? We're looking at 36 or 35. And when we go out here, we're looking at 32 and 31. So 5 pennies more. If we could get a little wider apart, say sell a June, buy a July or August even, the farther apart you can get, the better. And then there's how are you going to close it? The way that I taught it in the Marcus trade is that on Friday, the ones you sold are going to expire and that you need to be ready to decide what you're going to do with it. If they've lost money and you can buy them back cheaper to close, then do that, make your profit, and then ask, well, what am I going to do with these long options? One side or the other may have benefited. So if we're holding it and, say SPY ran, I know we're looking at Tesla, but say SPY ran higher, the calls are doing good, the puts are not. Close the entire put side diagonal, all of it, and then close the short call and leave the long call because, well, we're still going, and the long call might still make us money. But it really is a volatility trade first, price trade second, and equities in this example with Tesla sure gave us a nice example, this really, really nice M value. And it's well above zero, which is fantastic, right? We don't need Tesla to move at all, and this thing would make us money. But it's scary because, equities are mean reverting. They go back where they came from a lot. And so do sectors. But man, Apple, Tesla, Google, these guys can make big moves and not turn around and go back. I mean, look at what Meta did this year. It's just crazy. Or Netflix this year. That gets scary if you try to put on something like this and then you end up with $1,200 in the hole and you thought it was just going to be a nice, simple trade. Well, the front end is what we sell. So if we close the front end, all we have left is the longs at expiration, perhaps. Yeah. Oh, yeah, yeah, absolutely. Yeah. And also, the reason we have both sides is what if you get assigned early, right? Which can always happen. So if you sold a call and you sold a put, and then you bought a call and you bought a put, at any time they could exercise their rights and hit you. The good thing is you've got the longs to cover that position. That way you don't have to pony up the shares and or take assignment of shares that the other side will cover you. You got the long put and the long call to protect you. I know that when it was TD Ameritrade, I know that they would not. They would send you an email and give you 24 hours. And Tasty Trade would send you an email and give you 24 hours. I don't know what Schwab will do because I have never traded options for Schwab. I did it when it was TD Ameritrade. I would ask them, but two brokers that I know of, they'll actually give you the shares or, put you in the whole 100 shares and they'll tell you, okay, you got 24 hours to solve this problem. And I don't know what Schwab will do. I haven't been impressed with them so far. When I called them about other things, their answer has been pretty much suck it up, kid, and if you don't like it, too bad. Like, wow, thanks. I went back to the XSP and the expected move was 13. I rounded up to $13. So I sold a call and a put, and that gave me $2.50 in credit. And I'm gonna go out to the Monday after Friday, which would be June 2nd. And I'm gonna start with the same one. So it's a calendar at this point, but I'm willing to adjust after we get it built. So I got the 595 and the 565, and it's $95 for this trade, right? Less than a dollar. Throw it into the analyze tab. And of course, we got to turn some of this other stuff off. Now, there's our double diagonal. And when I built this in the video and I taught it in the Marcus trade, I discussed how this middle area is our risk. Because what if next week SPY does nothing, right? The S&P just doesn't do a jack and we sink down into this valley. Well, we don't want that, right? That's loss. So now we've got risk in three places. SPY can run and break the upper edge and we go into loss. We can fall, break the lower edge, go into loss, or we don't move at all and sink down and we have loss. Well, I don't like that. So, recommendations to get rid of the middle. You can put a butterfly there, completely separate. You would just build another butterfly. And my recommendation was do a butterfly every day so that you don't have to do just one big one to cover it. Put one on, for every day of the week as cheap as you can get it right at the money. But that is cost. Otherwise, the money that you spent here, this $95 or call it $1, $100, is going to be on top of this additional loss, right? So now you spent a dollar to get the trade, and you lost another 60 cents if we sink. Can't I cover that 60 cents somewhere? What about an iron condor, right? We could put on an iron, but that would increase the loss wings so that if we did get a big blowout move, we got to worry about that. And then the third thing would be, well, let's just adjust the strikes so that the middle doesn't sag into the zero line. And I like that answer better. And that's what I did in the video when I recommended this trade to people was widen it out to where the middle doesn't have a sag that goes below zero, or the sag below zero is like 2 or 3 pennies instead of $100 or so. This one is May and June, so we want to go to May 30. That adjusts our gray area for us, and we can see our break even is already well outside the line. So we could tighten it up if we wanted to, but we can also just push it out a little more and put the peak of this tent right there on the line. Right, so we want to adjust things a little bit, and by pushing it out, it should bring the middle up. Back testing systems have a really hard time with this kind of trade, by the way. If we hit confirm and send, you'll see it has a lot of unknowns or NAs in here because, as I demonstrated, the P&L can't be extrapolated. They have no idea what your max loss or max profit can be. They don't even know where your break even is because it's going to adjust as volatility adjusts. And a lot of firms do not like that because back testing can't be done and it's just leaving you hanging out to dry. Individually on your own, what I recommend to people is if you put this trade on, focus on what you sold those options for. Each one, what was the price? I sold it for, 85 cents, and this one, for whatever, $1.75. And then focus on those values as the trade unfolds. All four of them keeping track of their prices because this value, that debit of a dollar, that's not helpful to you whatsoever. Is my trade winning? Is it not winning? That number is not going to do you a damn bit of good. But what will help you is knowing, hey, I sold that 565 for $1.70 and we came in Tuesday and now it's only worth $1.30. Yay, I made some money, and we can adjust where do we want to close it? How much longer do we want to hold it? That sort of thing. This is a calendar, even though it says it's a double diagonal. So we can adjust the strikes. Say on the put side that we buy, we can go, let's go out. Oh, yeah, that's wild. And on the call side that we buy, $5.65 probably should have went to 560, not 570. That put us closer to the money. And that should have gone to 590. Yeah, there we go. Unlock it. Okay, well that widened it out, but it didn't solve the wings. So move this back to 95 and move that back to 65. Now we're back where we started. There we go. I just went the wrong way. So now we can see that the valley is above zero and it stays above zero for the whole position. But we came in a little bit too much on the call side, and now we would have to worry about the expected move coming too close on the upside. But we turned it into a diagonal, just changing it by 5 points, and there we go. I'm pretty sure it's confusing, right? Oh yeah, I love it. I'm taking a picture so I can put it in the chat, and just so that we can talk about what did we do here. Look at the ones that we sell. So here's the put 565. We sold that one and we bought the 560. So that's a $5 wide put spread, a difference of the weekend. And the trade would need to be closed on the 30th if we're going to close both at once before the 30th, preferably. We just monitor the trade, looking at that put that we sold, how much has it decayed? And that one that we bought, is it making money or losing money? And collectively, how are those two doing? And then we have the other trade where we bought a 600 call and we sold a 595 call. And that trade also $5 wide. Well, we never expect max, right? But technically, 2.5 on the bottom side, or 180 on the upside for max profit. Yep, that's about right. And it's opened as a credit now that we adjusted the spreads. We start the trade with $43 in credit. Because from here, the credit would just get bigger, and or we would fall out of bed if we escaped too far on one side or the other. The range really isn't that bad. If we set that range out on the chart, we'll put the break even on there first, and then we'll set it out to the chart. Let's go out to the daily here so we can see it. Now we've got a lot of lines now. I'm going to get rid of all those that say Tuesday's close because that's what we know isn't what we just put on there. We get rid of those. That's the range for this trade, and it's 1 week out. We would want price to stay in that box. It's not that bad, right? All things considered. If we compare that to the iron condor, right? What was that iron? The iron the iron was offering what, 50 cents? Something like that. $1.11 for this $5 wide iron condor right there. And I'm not far enough out. I should have went a little farther, but there you go. There's the iron for next week, May 30th, same expiration. But that's all you can get is that $1.11. And you have that risk, of $389, call it 390 if you break one side or the other, as opposed to the double diagonal where you have an opportunity to make 250 or 150, and then you start getting into the loss, which is 430 on one side and probably 480 on the other. More profit and certainly more risk, but your break evens are farther out. In the iron, they're much closer, right? I say much closer, but they're not that bad. We can change these so that they don't disappear, and then we'll add the other ones and see how much farther away they are. So those in red are the double diagonal, and those are the iron condor. So they're not greatly exaggerated between those two. The thing is, with the double diagonal, I bet I could keep adjusting the spread more and get farther away and still get more credit. Like I'm not done. I bet I could tweak it a lot more. But just being this much, we're already one offers way more profit than the other, and it is farther away, even if it isn't greatly far away, right? The double diagonal, I feel, is a better choice in the environment we're in because if volatility expands, this trade, the window gets bigger. The red lines will get farther apart from each other. The amount of money you can make in the trade gets bigger too, which is awesome. I am a big fan of the double diagonal. So the trade, if you're looking for it on the bullish bears, is called the Marcus trade. If you guys have questions, always you can hit me up. This is really a lean towards a weekly trade that we could do literally. I mean, every week. But the S&P has daily expirations, so we went 7 days out. What if we built it today and we had put it on Tuesday? We could have started another one 7 days away, and then on Wednesday we could have started another one 7 days away. You see what I mean? Like by the time you got to May 30th, you would have one on every single day of the week that's starting to expire, and you can just keep them going. And along the way, you would have chances to adjust things, tweak the settings, roll something in or out, up and down. That's where options really start to shine. Lock in gains. make them risk free, like I did that vertical. And that way you don't even pay attention to it anymore. You're like, whatever, it's in profit. Just move on to the next one. And then you don't have to worry about things like, CPI, FOMC, that sort of stuff, because it's already locked in and can't lose. I'm sure that was confusing. Check the video out that I put in the chat. It's unfinished, but I think it'll shed some light on some 0-day choices when it comes to strike selection. Everybody, it's a long weekend, so hopefully you get a chance to appreciate what this weekend is for. Spend some time with family, and I'll see you guys on Tuesday. You too.